This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Over the past several months, interest rate expectations in the United States have been shaped by one key factor: how quickly inflation is cooling and whether the broader economy can maintain steady growth. Earlier in the year, markets were actively debating when the Federal Reserve might begin adjusting interest rates after a period of holding them at elevated levels. Some expectations leaned toward earlier changes, while others suggested policymakers would remain cautious for longer. In the weeks leading up to now, those expectations have shifted several times as new data came in. Strong labor market signals and persistent service sector inflation led many analysts to believe that rates could stay higher for longer than initially expected. This week, financial markets showed signs of reassessing that outlook. Bond yields moved within a relatively narrow range, indicating that investors are still waiting for clearer confirmation from economic data before making strong bets on future rate changes. At the same time, commentary from analysts suggests that the overall expectation is becoming more balanced. Rather than expecting rapid changes in interest rates, markets are increasingly preparing for a slower, more measured approach from the Federal Reserve. Looking at the broader trend, the signal right now is one of patience. The period of aggressive rate moves appears to be behind us, but there is also no clear indication of immediate shifts ahead. Instead, policymakers are likely to remain data-dependent, adjusting their approach only when consistent trends emerge. For households, this environment has real financial implications. Mortgage rates remain relatively elevated, which continues to affect housing affordability. Credit card interest rates also stay high, making it more expensive to carry balances over time. On the other hand, higher interest rates can benefit savers. Savings accounts and fixed-income investments tend to offer better returns in a higher-rate environment, which can help households build financial stability. Many families are responding by focusing on reducing high-interest debt while taking advantage of better savings yields where possible. As a broader cultural reference, periods of higher interest rates often influence major financial decisions across the economy, from large business investments to consumer purchases, highlighting how deeply these policy choices affect everyday life. Looking ahead to next week, key signals to watch include updates on inflation, consumer spending, and labor market data. These indicators will play a major role in shaping expectations about the Federal Reserve's next move. If inflation continues to ease without signs of economic weakness, markets may gradually adjust their outlook. If not, the current wait-and-see approach is likely to continue. For now, interest rates remain steady, but the conversation around what comes next is still evolving. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with